how did you find the investors that you went with?
Well, it would help if you run a large wealth management firm and you're managing $400 million for 300 families.
Cool.
Like, that's yeah, but like even with that, my first investors were really my clients who are also like friends and family. Really early on, I got my dad involved. My dad is my partner. Um, I've made my kids partners in the businesses, using money that's mine, but I put it in their name so they could join in with me. But really, I think any endeavor like this is going to start with the folks who you know. I've never put up a billboard or, an ad in the newspaper. I kind of started with folks who I know. But then, so that's for your equity capital. For the debt or loan capital, I mean, there you're talking to banks. SBA is the SBA is the Small Business Administration. It is a kind of like a program by the government where banks have the opportunity to make loans that fit a certain criteria. And the government says, look, I'll be the guarantor. The government says that the government will guarantee the majority of that capital, which means the risk that the bank is taking with its own capital is really mitigated. It's really small. And so SBA loans are really a great tool for franchisees. The SBA maintains a list of like a naughty list and a nice list for franchisees. And so they can tell you in 5 minutes if this is a project that they might get behind. You may talk to the banks in advance of signing your franchise agreement because you'd hate to sign an agreement and then find out that no one wants to write a loan for that business.
And then what's a good ratio of like debt to equity?
That's an excellent question. So here's how I run my numbers. Like for one, I always run my numbers unlevered, meaning like what's the cost of starting the business and what is the EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I want to know, will I make my 30% or not just off the EBITDA versus the cash, the full cash that has to be put in, debt and equity, right? I then say, okay, well, if I can make my 30% that way, now let me figure out what's a responsible amount of leverage that I could add to still be able to, make a really good return, but not over lever. Because the challenge, this is now a judgment call. And this is where you might work with someone who's like got a financial mind to help you to like stress test it. Because, looking at it unlevered means like I need to see what is my need for working capital? Like how many months can I go without making a profit before I run out of cash? Now, if I add in a bank loan, I mean, that's great because now, hey, I got some free money. I put up air quotes. I get some capital that didn't come from my own bank account. But what does it do? It adds to my expenses every month, right? And so it might double the loss that you're making in those first couple of months. It might increase your need for working capital in the bank. So you kind of have to stress test it, and kind of work back and forth, because the banks will often let you lever up more than you should, frankly, because the banks will lend to you based off of a pro forma, and a pro forma, that's from a Latin word that really means to project, like it's a guess. And if your guess looks really good, then the bank's like, hey, where do I wire the money? Right. And you may have been too rosy, especially, I mean, I hate to say, if you're relying on what your franchisor says you can do, right? Like they may have been overly optimistic, and now you've levered up, for every dollar of capital, maybe you've taken on 80 cents of debt. And now you're short, because I'll tell you, like, you can't go back to the well and ask for more loan money. Like, you really got to get that right. So for me, I used to think like leverage as much as you possibly can. Like I didn't come from a wealthy background when I got into franchising. I'm using my own capital, and I didn't have a lot. So like I used to be very inclined to lever up. Then this thing called COVID happened, right? And like when COVID happened, I realized that leverage is one of those things that can cut both ways. Like leverage can certainly enhance your returns, but leverage can enhance your losses too. And you don't want to be in a situation where you run out of cash. And so I actually delevered my businesses during COVID. When I say delevered, meaning I took in some fresh equity capital to pay off the debt. Because the thing about equity is like, there's not a requirement that it gives a return, every single month. Like you can have a little bit more patience to your capital with equity, right? So for me, I would just be careful, and I'd make sure I ran a really good stress test. And then I'd stress it even more. And I'd be trying to figure out what's the optimal mix for me that maximizes my return, but also kind of mitigates the amount of risk of running out of capital. So the answer is a long explanation, but it kind of depends. I would be leery at going 80% debt. Like I'd be, even though the bank might let you do that, I'd be leery. Unless I had a bunch of extra cash laying around that I could use to pump into the business if things got tough.